Hey folks, let's talk about credit scores. It's something we all have, but many don't fully understand. A good credit score is like a golden ticket in the financial world. It can help you get lower interest rates on loans, better credit card offers, and even that dream apartment. It's time to unlock the secrets of a great credit score. Think of it like this. A good credit score is your financial report card. It tells lenders how responsible you are with money. Just like you want good grades in school, you want a good credit score in life. It opens doors and saves you money in the long run. Don't worry if your credit score isn't where you want it to be. The good news is that you have the power to improve it. With a little effort and the right knowledge, you can boost your score and achieve your financial goals. Let's dive in. So, what exactly is a credit score? It's a three-digit number, typically between 300 and 850, that represents your creditworthiness. The higher the score, the better. Lenders use this score to assess the risk of lending you money. Think of it like your financial GPA. Just like your GPA reflects your academic performance, your credit score reflects your financial behavior. It shows lenders how likely you are to repay your debts on time. Several factors contribute to your credit score, including your payment history, credit utilization, length of credit history, credit mix, and new credit. Understanding these factors is crucial to improving your score. Don't worry, we'll break down each of these factors in the following sections. Just remember, your credit score is a dynamic number that changes over time based on your financial habits. Now let's explore how to improve it. Before you embark on your credit score improvement journey, it's essential to know where you stand. That's where your credit report comes in. It's like a detailed financial history report that lenders use to evaluate your creditworthiness. You can obtain a free copy of your credit report from each of the three major credit bureaus, Equifax, Experian, and TransUnion, once a year. Visit annualcreditreport.com to request your reports. Once you have your reports, review them carefully for any errors or inaccuracies. Look for any accounts that aren't yours, incorrect balances, or late payments that you know were paid on time. Disputing any errors you find can potentially boost your score. Checking your credit report regularly is crucial for maintaining good credit health. It helps you stay informed about your financial standing and allows you to detect and address any issues promptly. One of the most significant factors influencing your credit score is your payment history. It accounts for a substantial portion of your score, so paying your bills on time is crucial. Think of it this way. Every time you make a payment on time, you're earning a good grade on your financial report card. Late payments, on the other hand, are like getting a big fat F. They stay on your credit report for 7 years and can significantly lower your score. Set up automatic payments or reminders to ensure you never miss a due date. If you're struggling to make ends meet, reach out to your creditors and try to negotiate a payment plan. Remember, communication is key. By consistently paying your bills on time, you demonstrate to lenders that you're a responsible borrower. This positive payment history will reflect well on your credit score and open doors to better financial opportunities. Credit utilization refers to the amount of credit you're using compared to your total available credit. It's the second most crucial factor in determining your credit score, so keeping it low is essential. Imagine your credit card has a $10,000 limit and you've spent $2,000. Your credit utilization would be 20%. Experts recommend keeping your utilization below 30%, but the lower, the better. To improve your credit utilization, you can either increase your credit limit or decrease your spending. If you're able to pay down your balances quickly, that's fantastic. If not, focus on making more than the minimum payment each month. Remember, high credit utilization can signal to lenders that you're relying too heavily on credit, potentially putting you at risk of overspending. By keeping your utilization low, you demonstrate responsible credit management and boost your score. You might be tempted to close old credit card accounts, especially if you're not using them. However, closing old accounts can actually hurt your credit score, especially if they're in good standing. Why? Because the length of your credit history is another factor that influences your score. Lenders like to see a long and positive credit history as it demonstrates your financial stability over time. Closing old accounts can shorten your average credit age, potentially lowering your score. Instead of closing them, consider keeping them open and using them occasionally for small purchases that you can pay off immediately. Of course, if you have an old account with high annual fees or one that tempts you to overspend, closing it might be the right decision. But for accounts in good standing, keeping them open can benefit your credit history in the long run. Having a diverse mix of credit accounts can also positively impact your credit score. Lenders like to see that you can manage different types of credit responsibly, such as credit cards, installment loans, and mortgages. Think of it like a balanced diet for your credit. Just like you need a variety of nutrients for optimal health, your credit score benefits from a mix of credit types. It shows lenders that you can handle different repayment structures and manage your finances effectively. If you only have credit cards, consider diversifying your credit mix by taking out a small installment loan, such as a personal loan or an auto loan, and repaying it responsibly. However, avoid taking on unnecessary debt just to improve your credit mix. Remember, responsible credit management is key. Only take on debt that you can comfortably afford and repay on time. A healthy credit mix, when managed well, can contribute to a higher credit score. Avoid applying for too much credit at once. Slow and steady wins the race. Applying for multiple credit cards or loans in a short period can negatively impact your credit score. Each time you apply for credit, a hard inquiry is recorded on your credit report, which can temporarily lower your score. Think of hard inquiries as dings on your credit report. While 1 or 2 hard inquiries within a year are generally not a major concern, multiple inquiries in a short time frame can raise red flags for lenders. Lenders might interpret this as a sign of financial distress or desperation, making them hesitant to approve your applications. If you're planning to make a significant purchase that requires credit, such as buying a car or a house, space out your credit applications to minimize the impact on your score. Remember, building good credit takes time and patience. Avoid rushing the process and focus on making responsible financial decisions consistently. Slow and steady wins the race when it comes to credit score improvement. Correct errors on your credit report. Be your own advocate. As mentioned earlier, reviewing your credit report regularly for errors is crucial. Mistakes can happen, and if you spot any inaccuracies, it's essential to dispute them promptly. You have the right to dispute any errors you find on your credit report. Contact the credit bureau directly and provide documentation to support your claim. The credit bureau is obligated to investigate and correct any verified errors. Common errors include incorrect personal information, accounts that don't belong to you, inaccurate balances, and late payments that were actually paid on time. Correcting these errors can potentially boost your credit score and improve your overall credit health. Remember, you are your own best advocate when it comes to your credit. Don't hesitate to dispute any errors you find and ensure that your credit report accurately reflects your financial history. Consider a secured credit card, a stepping stone to better credit. If you have limited or no credit history, building credit can seem daunting. A secured credit card can be a valuable tool in this situation. It's a type of credit card that requires a security deposit, which typically equals your credit limit. Think of it as a training ground for building credit. By using a secured credit card responsibly, making on-time payments, and keeping your utilization low, you demonstrate to lenders that you can manage credit responsibly. As you build a positive credit history with the secured card, you may become eligible for an unsecured credit card with higher limits and better benefits. The security deposit you initially made for the secured card is usually refundable once you've proven yourself as a trustworthy borrower. Remember, a secured credit card is not a long-term solution. It's a stepping stone to help you establish credit and graduate to unsecured credit products with more favorable terms. Take control of your financial future. You've got this. Improving your credit score is a journey, not a sprint. It requires patience, discipline, and consistent effort. But the rewards are well worth it. A good credit score can save you thousands of dollars in interest payments, open doors to better financial opportunities, and provide peace of mind. Remember, you have the power to shape your financial future. By following the steps outlined in this video, you can take control of your credit, boost your score, and achieve your financial goals. Don't let a less-than-perfect credit score hold you back from living your best life. Start implementing these tips today and watch your credit score soar. You've got this.